Okay, you can see the screen now.
Yes, sir.
So from here we are supposed to begin right now. Working
Yes.
capital and liquidity. So cash conversion cycle is basically cash conversion cycle is equal to so how you think is, first you are keeping the goods in inventory, you are buying and keeping the goods in inventory. So how many days it takes? So number of days of inventory turnover, how many days it is there. Okay, then plus number of days of account receivable, because once you sell you are not going to get the payment immediately. Number of days of account receivable, then minus number of days of accounts payable. Say for example, you are keeping it in the go down, that means inventory, for let's say 30 days, then you are giving 60 days credit period, so total 90 days you are taking, minus, but you are also delaying somebody's payment, right? So let's say 50, so total 40 days is the cash conversion cycle. So lower it is better. It may even go to negative also for some companies. Say for example, if you are taking 100 days to make the payment, then it will become minus 10, which is very good. Okay.
Okay.
Fine. Now, if I say, then what is conversion cycle? Conversion cycle is number of days of inventory turnover plus number of days of account receivable. So inventory turnover is 30 plus 60. This is called conversion cycle. That means here you will not factor in accounts payable. This conversion cycle is also called as operating cycle. Okay. Conversion cycle is also called as operating cycle. Operating cycle. So these are all this. So basically, it measures the efficiency of the cash flow management. These all are something we have done already. See this. I'll quickly explain that also. So, what is number of days of inventory turnover ratio? Okay. So first of all, number of days of, no, before that one, we need to know what is inventory turnover ratio. Inventory turnover ratio means what? How many days inventories are there in the go down? Okay, what is the formula? Do you remember? No?
Cost of goods sold upon average inventory.
Yeah. Correct. Okay. So basically, this will tell you, say for example, if inventory in a year, average inventory is every time 100 rupees, and cost of goods sold is total coming to 1200 in a year. So that means after every 12 days, you are going to the market and you are buying inventory. Okay, so it is like this. You are doing one, you are buying today from the market, and then you are keeping it for 12 days. Okay, you are keeping it for 12 days. Yeah. Then after, then again you are, selling it. Then again you are bringing the inventory. Then again you are selling it. it is taking 12 days to sell, and then again after you sell, again you are bringing the inventory, and again it is taking 12 days. Okay, so inventory turnover ratio means after every how many days you are going to the market and buying inventory. Okay, so that is 12 days, 12 times. So this is telling you, this is telling you how many times in a year. How many times in a year? So how many times in a year you are going to the market and bringing inventory? How many times in a year? So 12 times you are doing. Now, if I want to know after every how many days I'm buying, so this is telling you how many times in a year. Now, if I want to know after every how many days, you are going to the market and buying inventory. Okay. So that means that is called as days of inventory receivable, or number of days of inventory turnover. Okay. Is equal to 365 divided by inventory turnover ratio. So 365 divided by inventory turnover ratio is 12. So just calculate this.
30.4.
So that means after every 30.4 days, you are going to the market. That's why it is 12 times in a year. 12 times in a year means after every 30 days. No? So after every once in a month, you are going to the market. Okay.
Is it that inventory turnover ratio should be lower?
No, inventory turnover ratio, it should be at par with the market. It should be at par with the market. What if it is too high? If it is way higher than the market, that means you are again and again. So if instead of 12, imagine this is the industry standard, 12 and 34, 30. Now suppose your inventory turnover ratio is 24. That means double times market is, going to the market and buying 12 times in a year. But you are buying 24 times. That means it is getting over again and again in your go down. And then you are running to the market and buying it. So here you might fall short of then goods in your company when it is required. So it might impact your sales, right?
Yeah.
It might impact your sales. Okay, so that is why this number too many times. That means you're too many times. It also means that see, two ways you can understand. One is maybe you are doing too good sales, and that is why it is getting over again and again, and then you are running to the market, or it is doing too good sales, but then in that case you are not keeping enough inventory. Then that is going to impact your business, no? So the ideal number is to be at par with the market. Okay, and if it is too low, then what will happen? So if it is too low, instead of 12, if it is 6, then what does that mean?
Not enough sales.
That means no sales are happening. Interpretation. Second interpretation could be like yeah, no sales are happening, or overstocking of inventory because you have overstocked. When you are overstocked, that means what? That means you are locking your working capital, right?
Yes.
Okay. Yeah. Uh, okay, this is also fine. Yeah, same logic. Now we have to apply for days of inventory turnover, then accounts payable ratio. Accounts payable ratio is equal to accounts payable ratio is accounts payable ratio. No, accounts receivable ratio we'll do first. So, accounts receivable turnover ratio is equal to so the formula account receivable is credit sales divided by average account receivable. So say for example, average account receivable every time it is 100 rupees and you have done credit sales of 1200. That means you are doing one sales, then average account receivable you are creating credit sales 100, then it is there for let's say here how you should understand is 12 times you are doing this. Okay, so this is telling you 12 times people are coming and making the payment. So here you are doing one account receivable, you are doing one credit sales, then after few days you are getting the payment. So once you get the payment, then again you are doing credit sales. So here it was 100, then it becomes 0 here, then again you are doing credit sales, then again it becomes 100, then again you are getting the payment here, then again you are doing credit sales, then again it becomes 100. So every time it becomes 0, then immediately it becomes 100. So this is happening 12 times in a year. Okay, 12 times. Now you want to know after every how many days. So after every how many days is days of account receivable turnover ratio is equal to 365 divided by account receivable turnover ratio. Account receivable turnover is 12. So that comes to 30.4 days. Okay, that means after every 30 days, people are coming and paying. Okay, here after every 30 days, you are going to the market and you are getting inventory. And yeah, and here 12 times in a year. So after every 30 days, you are going. So that's why you are going 12 times in a year. Then account receivable turnover ratio, then accounts payable turnover ratio. So that is equal to payable is credit purchase. So credit purchase divided by average accounts payable. So that means you are doing a credit purchase, then you are creating accounts payable. Okay, so let's say that is 100 rupees credit purchase. Then accounts payable is 100 rupees. Then after few days, you are paying back. So when you pay back, it will become 0. Then again you are doing credit purchase. So again it will become 100. Then after few days, again it becomes 0 because you are paying. Then again you are doing credit purchase, it becomes 100. Again it becomes 0. Then again you are doing credit purchase. So imagine in a year, it is happening again and again. So average accounts payable is 100. Every time you have 100. And in a year, imagine 1200 rupees you have purchased for. So this is 12, accounts payable turnover ratio. Okay. Then days of accounts payable turnover ratio, 365 by accounts payable turnover ratio. So this is 12. So 30.4 days. That means after every 30 days, I'm doing the purchase today. After 30 days, I'm paying. Then again I'm doing. So 100, 0. Then after 30 days. So this is 30 days. Becomes 0. Then again 100, 0. Then 100, 0. Then 100, 0. And then 100. Okay. Yeah. Accounts payable. So this is days of accounts payable turnover ratio. Okay, so all this comes under activity ratios. Activity means it will show the efficiency. Okay, and based on all these days, we can get that CCC, cash conversion cycle. This one, and this one used in cash conversion cycle. Okay, days of inventory, days of accounts payable, and then all this. Okay, so yeah. Next one. So see, there is a formula given here, but you don't have to remember the formula as such. This is EAR stands for, where is EAR mentioned? Okay, it is equivalent annual return. Okay. See this question. A supplier offers 2 by 10 net 30 terms. The bank interest rate is 8%. Which source of financing should the company prefer? So how you should understand this is, first of all, what is 2 by 10 net 30? So 2 by 10 net 30. So 2 by 10 net 30 means what now? It means, see what it means is supplier is offering 2 by 10. That means the supplier says, that means you have purchased on credit basis. You have purchased on credit basis. Now, when you have purchased on credit basis, then what happens? 2 by 10 net 30 means You are purchased on credit basis, okay. Then credit basis. Okay. So what this means is, the supplier says, I will give you 2% discount if you pay. I will give you 2% discount if you pay in 10 days. Otherwise, no discount, and you have to pay all in uh, 30 days. This is the meaning. Okay. This is the meaning. Okay. So now we have to see whether this offer is making sense or not. So how to find out whether this offer is making sense or not? So it is all about, actually this is the real part, right? In 10 days, 2% discount, whether this is making sense or not. So that means in 10 days you are earning. That means on the, obviously when they say 10 day, you are going to pay on the 10th day only. So 10th day if you pay, you will get 2% earnings. That means per annum how much? That is equivalent annual return, EAR. So we'll see that one. N will be 10 days, they said, right? So 10 means 10 by 365. It will give you years, right? It will convert it into years. Then IY is what we need to calculate. Present value, see, 2% discount, they said. That means you think 2% means out of 100, right? So future value is 100. If you have purchased for 100 rupees, you are earning 2%. So it will become 98. Your present value is 98. Payment is 0. Okay. Now you calculate IY. It is already in years. Okay. 10 by 365 is N is in years. Calculate IY.
Minus 100.
How minus 100? No. Just calculate again.
I'm getting 109.40.
No. We're not doing properly. Wait.
N is coming to 0.027.
How much you said? N is 10 by
365.
365. Okay. 10 divided by that is divided by 365. That will come in N. Then present value is 98 minus. That will come in present value. Payment is 0. Future value is 100. Compute IY. Okay, I should make it little bit, this decimal number. Second format, I'll make it like 8 decimal. Enter. Okay, so 10 divided by 365. This is my. Acha, this one I must have done incorrectly before. This number I didn't get, na? This is n. Then present value 98. Then 0 is the payment. Then 100 is the future value. Compute IY. 109. 109.
Yeah, that's what I was thinking.
N is. Acha, N is not 10. N is 20. Because in 20 days, remaining 20 days you are earning. 20 divided by 365. Okay, that is N. Present value is 98 minus payment is 0. Then 100 is the future value. Compute IY. 44.58. Okay. So N is basically 20 days. Why 20 days? Because 10 days you are paying. So you are saving those 20 days. In those 20 days only you are earning. Because you are paying money. So it is all about 20 days. 20 days, the money is not in your hand, right? You understood this one?
Yes.
20 days. Because out of this 30 days, this is 10. So here you are paying. That means 20 days, the money is not in your hand. So your investment is for 20 days. This money you could have utilized it this many days. But you are giving it to the supplier. So it is all about 20 days investments. So it should be 20 by 365. Okay. So that you should be careful about it. This is 20 days. Okay. So this way you can do rather than remembering the formula. If you want to go with the formula, this is also mentioned here. Okay. So percent discount. So if you want to try that way also, you may try.
So if we wait for 20 more days, then this is what we get. Is that what it means?
If we if we wait for 20 more days, then okay, see what it means is you are making the payment earlier. So in a way, in a year's time, they said when you are making the payment earlier, they are giving you 2% return. But when you convert it annually, it comes to 44% return. So when it comes to annually 44% return, the bank is offering 8% only. That means per annum bank is offering 8%, the supplier is offering 44% return. All we have done is we have converted his offer into per annum basis. So per annum basis, supplier says I will give you 44%. The bank is giving only 8%. So what makes sense is to borrow from the bank and give it even if you don't have money. Why? Because bank is charging only 8%, whereas this guy, assuming, see, this deal will get repeated. That is the assumption. That means in a year you keep on buying stuff. So when you keep on buying stuff, when you keep on getting this discount, in a year it comes to 44% discount. So when to receive this 44%, it is okay to pay 8% to the bank, right?
Yes.
Okay. So that is why we have to compare like this, and so this 8% makes sense. I mean, 8% makes sense means it is better to borrow and then give the supplier this amount in advance.
Okay.
So here it is mentioned. Okay. Yeah, if you want to try this way, it will be 1 plus percentage discount is 2% discount divided by 1 minus 2% raised to 365 by C minus B. C is days until full payment is due, days until discount expires. So here it is 20 days. So 30 minus 10. Okay. So 1 plus 2% divided by 0.98 raised to 365 by 20. And then minus 1. Okay, this is the formula. If you want to go by the formula. Fine, okay.
Yes, sir.
Basically for 98 rupees, 2% discount. Okay. Okay. Okay, this is not required though. Current asset net working capital is current assets except cash and marketable securities minus current liabilities except short and current debt, short-term debt and current debt. Okay. I have not seen this question anywhere, but if you want to remember formula, you may. Then primary liquidity sources. That means for liquidity. So how do you manage liquidity? It is through cash and marketable securities on hand, bank borrowings, cash generated from the business. All these are primary source, which are not very expensive. Cash generated from the business is your money only. Bank borrowing is lower cost of borrowing. Then cash, marketable securities, all are within the company. Secondary means which is troubling you, which is forcing you. So example, see this, you are suspending dividends and you are saving money. That means you are in trouble. So secondary liquidity shows that you are in trouble. Delaying or reducing capital investments, trouble. Selling assets, trouble. Issuing additional equity is also trouble only. Okay, it looks counterintuitive. Okay, why so? Because issuing additional equity means you are diluting the ratio. Okay, and so diluting the ratio, voting power goes away, and the cost also will be very high, right? Because cost of equity is the most expensive one, right? Then restructuring debt, bankruptcy. So all these are problem. So here, why I have given this blue color over here is because this I feel it is counterintuitive. Okay, bank borrowing, people might think it is secondary, and issuing additional equity, people might think it is primary. So I just So quite possible that they may test these two, issuing additional equity and bank borrowing. So issuing additional equity is secondary, bank borrowing is primary liquidity sources.
Okay.
Then this if you ignore also, it's fine. This is very, it's not making it's very simple only. See, all they have done is, this is the fair value of all this. This is the cost of liquidation. When you liquidate, you are incurring some cost. So here 15% is gone. It's a very simple form sum only. There is nothing in it. If you ignore also, it's fine. I'll just quickly do this still. So here 100, 200, 300. Now cost of liquidation is 0%. So 0%. So you will get 100 here, all 100. Here 15%. Take 15% of 200. It will be 30. Right. So that is your cost of liquidation. So you will be left out with 170. Then take 30% of 300 will be 900. 30% of 300, 900 is gone. 900 or 90?
9.
90.
Yeah.
90 or 9? 30% of 300.
90.
90. So 210. That's it. This is the net amount. Just add up all this. This is the cost. Cost is 120.
$410. $480.
Okay. So now the question is, so calculate the total proceeds. Total proceeds is 480. And the cost of liquidity. Cost of liquidity is 120 in dollars in percentage. So 120 means 120 is gone out of 600. Just calculate this into 100.
20. 2%.
120 out of 600 is 20%. Okay.
Yes.
Okay. Now factors affecting liquidity. These are some theories. Drag on liquidity and pull on liquidity. Drag on liquidity occurs when cash inflows lag. That means others are not paying you on time. Your debtors are not paying you on time. This can occur when excess inventory builds up. That is also possible. Or when inventory becomes absolute, so over inventory. Or when collections are slow. So money is locked up here. This is drag on liquidity. Pull on liquidity occurs when cash outflows accelerate. That means you are paying too fast. That is pull on liquidity. Okay. Pull on liquidity. Okay. Fine. These two terms you should know. Then these are all very common thing. Current ratio, quick ratio. Now the difference is in quick ratio. So current ratio current ratio is equal to cash plus marketable securities plus accounts receivable plus prepaid expenses plus inventory. Okay, that is current assets divided by current liability. Current liability, there is no change in any ratio. Current liability is all short term. Okay, now here quick ratio means is equal to cash plus marketable securities plus account receivable. These two will not come, divided by current liability. So this is stricter way. Cash ratio means account receivable will not come. Cash plus marketable securities. Cash plus marketable securities. So these are stricter way to find out. Then, yeah. These you should also know the heading, okay? Liquidity ratio. That is also equally important. It comes under liquidity ratio. Okay. This again, you want to try this quickly. Just try for 2002 quickly. Just check.
Okay.
Current ratio, quick ratio, cash ratio. They have mentioned for 2 years. You do it only for 2002 now. For 2001, you do it as homework. Okay. It's very easy only. Just do now. Just do it. I'll be back in a minute. Okay. Just this.
Okay.
Hello.
Yes.
Yeah. Are able to do?
Yes.
Is matching all this? 2002. It's a straightforward only. There is nothing, no
Yeah.
twist. Okay. But these are all simple theory that self-reading only. Then capital investments and capital allocation. Capital investments and capital allocation. Okay. So here, capital allocation means where that capital has to be allocated. Okay, because you will have multiple projects. Okay. Then, yeah, net present value. Okay, this is an important one. This definition is also important one. Mhm. Then, yeah, so what is this now? Net present value. So net present value is net present value. Yeah, this is also important one. It increases the wealth, and negative will destroy the wealth. These are all important theories. Yeah, these are all important theories. Okay, let's do this sum, and then you read theory, you will understand better. Just go through this question now.
Done, sir. Ah. So now this is your project where this is the cash flows. That means in this project, you think like as if you have got permission to to do cafeteria business in your college for 3 years contract. It's a 3 years contract. Now in 3 years you are going to run this cafeteria business. Initially you have to shell out 100 rupees, okay, to set up the business cafeteria. After that you will get 25 first year, and second year you are expecting 50, and third year you are expecting 75. So if this is the case, what is the net present value? Net present value means finally how much are you earning?
finally how much am I earning? Here it looks like 25 plus 50, 75, 75 plus 75, 150. So I'm earning 50 rupees. But actually that is a wrong way to calculate, because you are also incurring some cost of capital. If this 100 rupees is not coming freely in your hand. So cost of capital is 9%. That means you are going to pay 9% to the bank as well. So whatever money you are getting here, 9% you are still further going to lose. 100 rupees you have given here, further 9%. So what you should do is you should discount all this amount by 9%. 1 plus 9% raised to 1. You can even see, this is cost of capital or inflation rate. All this can be used as the discounting rate. Okay. So here also 9% for 2 years. 1 plus 9% for 3 years. Just calculate all this. First one, how much? Second one?
21.04.
21.0.
4. 19.30.
How 19 only? This is 75, na?
75.
Even this is also 50. It is coming to 21 only, I doubt.
Third one is 57.91.
Second one, check again.
Yeah.
Keep storing also.
Okay. This is 42.0.
Hmm.
$122.8.
Hmm. 122, and this is minus 100. So that comes to 22.81. So net you are earning how much? 22.81. This is the net present value.
So what do we compare this with to make a decision?
So basically now initially we compared all these 150 rupees with 100, and then we thought 50 rupees we are earning. Then we got to know that we are supposed to discount, and so we are getting the discounted value is only 122, and that we compared with 100. So now we understood that we are actually earning only 22 rupees, 22.81, but which is still positive number. As long as it is positive, we should accept the project. Suppose if overall this number comes to be like minus 10, imagine if it is minus 10, then what will I do? I will not accept the project. It's like I'm giving 100 here. At the end, I'm not even receiving my money. It's a loss making project for me. Okay, say for example, assume that instead of 75 here, it is coming to 55. Okay, now you calculate.
42.47.
42.47. Now you add up all this 22, 42, 42.47.
107.37.
Okay, 107 means I'm still getting 7 rupees. So let's say if I reduce this to something like 40 rupees.
30.8.
Yeah. So 30.8. Now you add this 1, 2, and 3.
Yeah, 95.7.
Then I should not take this project. Why? Because 95.7 minus 100 is what I'm at loss. 95.7
Yes.
minus 100, I'm at loss.
Okay, understood.
Okay. So the project is positive, so it should be accepted. Project has a positive NPV. That means this number, positive number. Finally, you are getting cash. Okay. As long as it is positive, it should be accepted. Okay. These are the steps, which is not required. We have already done. Now, okay. Now, probably you should read this theory. Now you read this theory. All this highlighted part.
So what is independent projects?
Independent project means one project is not connected to another projects. This is one project and this is another project. So these projects are independent. Okay. And where is that line mentioned here?
Last paragraph.
Yeah, for independent project, the NPV decision is simply to So this is one project A and this is project B. Now the problem is you have limited resources, right? You have limited capital. So let's say here it requires 1,000 rupees and here it requires 1,000 rupees. But you have only 1,000 rupees. So you can go for either A or B. So these projects are not connected with each other. They will use one more word called mutually exclusive also. Mutually exclusive. Mutually exclusive means either this or this only you can go for. You cannot go for both. Okay, mutually exclusive means what? You cannot go for both.
Okay.
Okay, then that is called, so only one you can go for. Then what should you do? You should go for the one where you are getting maximum NPV. Maximum NPV, wherever you are getting, there you should go for. Okay. So
Okay.
independent project means these are all different projects are there. So because you have limited capital, you have to select one. So then it becomes mutually exclusive. See here, that's why they said reject with negative NPV. So they both are independent. Imagine here you are getting positive NPV 22 and here minus 10. Then you reject the second one. Okay. You read in this theory. Achha, that's it, right? Theory there. But important one, okay? Now IRR means what? Now IRR, so this is also an important one. This equation also. Now IRR, so you are spending 100 rupees. What you will get is or the way I wrote before. Say 0, 1, 2, 3 minus 100, 25, 50, 75. Now I want to know what is that rate, that X percentage what is that rate which will what is that rate which will make this value equal to 100. Now at 9 percentage we got 122, correct, in the previous case.
Yes.
So if I increase this rate, the amount will come down. If I increase this rate, because the denominator will go up, so this 25 which has become 22 will go down further. This 42, this 42 will go down further if I increase this rate. If I increase this rate, this 57 will go down further. So what is that rate which will bring it to 100 total? So that 100 minus 100 will be 0. That way. Now you cannot do this, directly here as a formula. You cannot do. You have to use trial and error method only here. Either trial and error. You have to take any number and you have to keep on checking, which will be time consuming. Instead, there is a shortcut in your Calci. So I'll tell you how to use it in your Calci. Even the first sum also you could have done in your Calci itself. So that this also I'll tell you how to do in your Calci. See. Now here, come to cash flow function. This one. Have you used this before, cash flow?
Yes.
Okay, cash flow function. So initially CF0 is what? Minus 100 cash flow. So you type minus 100 and then minus enter. Minus 100.
Done.
Then downward arrow. Then C01 is cash flow at time 1, which is what? 25. Enter.
Yeah.
Then downward arrow. Frequency, you ignore it. Right now it is not required. Maybe 1 or 2 sums are there in the mock test or website. That time when you will ask, I will explain it to you. This is just a shortcut way. So if you ignore now, it doesn't matter. This is frequency. Frequency means only one time this amount is repeated, right? Only one time it is coming up. So let it be only once, like this only. You have to just ignore it. Then cash flow 2, downward arrow. Cash flow 2 is again 50, right? 50. Enter.
Yeah.
Then again downward arrow. Frequency is 1 only. You have to ignore frequency, as I said. Then C0 is 50, right? 50. Enter.
It's 75.
Oh, sorry, it is 75. No? So 75. Third cash flow is enter. Okay. Then 75. Okay. Now, after keying in all the data, you click on NPV. Okay, and then it is asking what is the discount rate. This interest means discount rate. Discount rate is 9%, right? Don't put percentage, just type 9 and enter. And then downward arrow. The system will show 0. Now you click on complete. Okay, have you understood this one?
Yes.
Okay. Okay, now I'll clear it all. Now I want to calculate IRR. So how do I calculate IRR? IRR means what? IRR means what should be the rate at which present value of, so IRR, if I have to articulate, IRR is the rate at which present value of cash outflow is equal to present value of cash inflow. Present value of cash outflow is equal to present value of cash inflow. Okay, so how will I get to know that rate? That rate is called IRR. So as I said, you cannot do this manually. You have to use this calci. So how to do here? Again, we will do first cash flow function. Go to cash flow function. See, if you go to cash flow function, you will see all previous work here. So what you should do is you should clear it off. So once you go to cash flow function, you do second clear work to clear it off. Again, you go to cash flow. I think it is not cleared. Second clear work. Is it happening for you in your calci? I think here it is not working.
It happened for me.
Yeah, so here there is something wrong then. Okay, I'll just manually do 0, enter. I'll just make it all 0 manually.
Okay.
Okay, anyways. After going into the function, you have to do second clear work. Okay, so here, cash flow function, it is not going for me. So I'll just replace it. So I'll do it again then. Here, see 100 minus enter. This step is okay.
Yes.
Downward arrow. So 25, enter. Downward arrow. Again, downward arrow. Come to, this is cash flow. There is something wrong here. It's not working properly for me. But I'll open this again, calci, okay?
Yeah.
I'll keep it like 8 decimal. So second format, so I'll change this format to 8 decimal now. Second format, eight decimal I want, enter. Okay. Now cash flow, I'll type 100 here, minus, enter. Then first year cash flow, first year is 25, enter, 25, then downward arrow. Frequency I'm going to ignore. Cash flow 2 is 50, enter, then downward arrow. Frequency I'm going to ignore. Cash flow 3 is 75, enter. Okay. Then I will click on, so have you done till here?
Yes.
Click on IRR. It will show 0, click on compute. So 19.43 percentage. So if I use 19.43 percentage, I will get 0 NPV. So that means, let's just cross check that, 19.43. Okay, this is not 4, this should be 3. So 19.43 percentage. 19.43 percentage. 19.43 percentage. Now you calculate first one. What do you get?
20.93.
Keep storing. Second one.
35.
Hmm.
$44. 100. Yeah.
100. Okay, that means overall, actually, you are earning 19.43 percentage in this project. Okay, 19.43 percent. That is IRR. Okay, obviously, this IRR should be greater than your cost of capital. Otherwise, it doesn't make any sense, right? IRR should be greater than your cost of capital. Now, when I say IRR should be greater than your cost of capital, that is right. But then, suppose if you find a case where between NPV and IRR, which one will you prefer more? So imagine there is a case, project A, project B. Project A, project B. Let's say IRR is 15 percentage, 10 percentage. NPV is 8 rupees, 20 rupees. Now tell me which project will you select? It is mutually exclusive. That means only one you can select. If you go by IRR, this makes sense. If you go by NPV, this makes sense. So now what will you select? So you should, when you get this kind of,
Project B.
huh?
Project B, higher NPV.
You should prefer higher NPV.
Project
Okay?
B.
Yeah. Why higher NPV should you prefer? Why not IRR? Because NPV is exactly giving you the idea of the amount. Finally, you want the amount only. Right? You don't want the percentage. You want the amount in your hand. Finally. Okay. So that's why NPV, between IRR and if there is a conflict between IRR and NPV will win. Okay. Yeah. Okay, now you may read all this. All this green highlighted you may read.
Done, sir.
19.43 percentage. Then, okay. Then conventional cash flow pattern and unconventional cash flow pattern. Conventional is what we have done now. So this is also theory.
Conventional cash flow means where you are paying cash. I mean, initially there is sign is changing only once. See here, sign is changing only once. Okay, all this sign did not change here. This is called conventional cash flow. Conventional cash flow. Okay. Then unconventional cash flow means unconventional cash flow means sign is changing multiple times. So let's say this is 25, then here it is minus 50. Any number doesn't matter. So let's say if it is minus 50 here and then plus 35. So when the signs are changing again and again, then it is called as unconventional cash flows. Unconventional cash flows. Is it okay? Unconventional.
Yes.
So unconventional, you will find that we are not doing any sums on unconventional cash flows now. I think it is there in website or mock somewhere it is there. But by the time when you reach there, you will be able to understand. Okay. By the time you reach there, you will be able to understand. So this is to build the basics. Right now, we are not doing any sums like this. Okay, it is easy only, but we are not doing that one because now it is more important to build confidence on this kind of simple sums. Okay. Then advantages and disadvantages of the NPV. Okay, so yeah, so this is just read this, see if you are able to understand all this. This one. Advantages, this NPV advantage is what directly it is telling you what is the value increase happening. Okay. So that much accordingly stock price also will go up.
Done, sir.
The disadvantages of IRR. It assumes that it is reinvested. That means now when we got 19%, that means as if like we are reinvesting at 19%. Practically, it is not possible to reinvest at 19% also. Okay. So that is the disadvantage. Whereas the NPV assumes that it is reinvested at the projected required rate of return, which was 9% for us. So 9% is practical, but then to say 19% is not practical. Okay, so see, that's why this is more realistic. And what is this multiple IRR that you will find in unconventional cash flows? Okay, that are difficult to interpret. That at the moment, you just see this theoretically. Practically, we'll see when the sum comes. Okay, so you will find multiple IRR in this unconventional cash flows. Unconventional cash flows. Then return on invested capital. This is all direct only. Return on this is all formulas only. Written on NOPAT means what? NOPAT means EBIT into 1 minus NOPAT is not net operating profit after tax. Net operating profit after tax is equal to okay, it is, the formula is given here, not given. Yeah. So NOPAT is equal to EBIT into 1 minus tax. EBIT into okay, EBIT into 1 minus tax. EBIT into 1 minus tax rate. Okay. So that means I'm not taking interest into factor directly from this EBIT. See, normally you remember what we do, like revenue or sales minus cost of goods sold. Then we get gross profit minus sales general administration expenses, EBITDA minus depreciation, EBIT minus, see, normally
Interest.
this is how we do, no?
Yes.
Earning before tax minus tax net profit. Now from this EBIT directly you are paying tax. Okay, so assuming there is no interest, then it is called as NOPAT. After this, what you get is called as NOPAT. Here you will get NOPAT. NOPAT. So NOPAT divided by average book value of invested capital, because that return on invested capital, that is the formula. Now return on invested capital, NOPAT divided by average invested capital, that can further be written as, so return on invested capital is equal to NOPAT divided by average invested capital. I think the net is weak here. Average invested capital. Now that I can further write as NOPAT by sales into sales by average invested capital. NOPAT by sales into sales by average invested capital. Okay, so NOPAT by sales. NOPAT as in, you think like this is profit. So this will tell you whether the business, the return that you are getting, it is because of the margin. This is called operating margin. Yeah, this is called operating margin after tax. Operating margin after tax into capital turnover ratio or asset turnover. This one, capital turnover ratio.
So ROIC is the product of operating margin after tax and invested capital turnover. Okay. Return on invested capital. Clear till here? So this will tell you whether if your returns are going up, it is because you increase the price or you increase the sales. First one is you are increasing the price, so your profits has gone up. Second one is you are increasing the sales, so your profits are going up. Okay.
Okay.
I think that's it here. Rest you just read and try all these questions. Then here, this will get over now. Maybe in 1 or 2 sessions, it will be done. Okay. We'll stop now here. Okay.
Okay.
Yes.
Thank you, sir.
Okay. Bye. Bye.